A woman named Lisa borrowed $300 from a payday lender in North Carolina. Over the next 17 months, she paid $1,254 in fees. When those 17 months ended, she still owed the full $300. The loan had not been paid down by a single dollar. She paid more than 4 times what she borrowed and was right back where she started. Okay? There is a name for this. It is called the poverty tax. And it is not a metaphor or a political slogan. It is a real, measurable surcharge applied to millions of Americans specifically because they cannot afford to pay upfront. All right, when you have money in reserve, you pay for something once and you are done. When you do not have that reserve, you pay for the same thing over time. And paying over time always costs more. A flat screen television at retail costs $729. The same television at a rent-a-center paid weekly runs $19.99 a week. Pay every week for 2 years, and you have paid $2,078 for the exact same television. The only variable is whether you could afford to pay all at once. Apply the same logic to your paycheck. Check cashing stores charge 2% per check. On a $700 paycheck, that is $14 every 2 weeks. Over a single year, that is $364 just to access money you already earned. A bank account would cost you nothing, but bank accounts require minimum balances, and minimum balances require savings you do not have. That is why the check cashing store exists on the corner where the bank is not. Check this out. A 2022 analysis by the Consumer Federation of America found that drivers in minority zip codes pay between 28 and 30% more for car insurance than drivers in white zip codes with identical cars, identical records, and identical coverage, okay? The only variable is the address, and that address was not chosen randomly. A $15,000 car loan at 5% interest costs $16,900 over 5 years. The same loan at 20%, which is the rate subprime lenders charge borrowers in the low credit score range, costs $20,200. That is $3,300 more for the same car, the same loan amount, the same 5-year term. The only variable is the credit score. And the credit score reflects whether a bank ever opened a branch in the neighborhood, whether the family before you was allowed to build equity, whether you ever had the financial history the score is supposed to measure. Overdraft fees run $35 per incident at most major banks. A low-income account holder overdrafts an average of 6 times a year. That is $210 annually charged specifically to the customers whose accounts dropped below zero. A customer with a savings buffer pays nothing. The same bank charges different customers different annual costs based entirely on whether they had enough to avoid the fee in the first place. American banks collected $8 billion in overdraft fees in a single year. 70% of it came from 9% of their customers. Yeah, that 9% earns under $50,000 a year. All right, the housing version may be the clearest illustration of all. Renting an apartment requires first month plus a security deposit before you move in. On an $800 a month apartment, that is $1,600 up front. Without that capital, you rent by the week at a motel. A weekly motel rate in most American cities runs $250 to $300. That is $1,100 to $1,300 a month for the same living space that would cost $800 in an apartment. You pay $300 to $500 more every single month because you could not produce $1,600 to start. And every month you pay the motel rate, you fall further from the deposit that would end it. In 1934, the federal government launched a program to stabilize housing after the Great Depression? Surveyors went city by city and rated every neighborhood on a scale from green to red. Neighborhoods rated green received access to federal mortgage capital. Neighborhoods rated red were deemed too risky and cut off. The criteria for red explicitly included the racial and ethnic composition of the neighborhood. Those federal maps determined which communities would build equity over the next 5 decades and which would not. You can still see the lines today in which neighborhoods have banks and which have check cashing stores. After World War II, the GI Bill offered veterans subsidized mortgages, college tuition, and business loans. It built the American middle class. All right, but in Mississippi, fewer than 2 of the 3,229 VA mortgages extended after the war went to black veterans. Those loans created homes, equity, and collateral for future borrowing. Almost all of it flowed into white families. The communities left out of that process are, in many cases, the same communities where a bank branch does not exist today and a check cashing store does. Then in 1980, Congress passed a deregulation act that effectively ended state usury caps, the laws that limited how much interest a lender could charge. Okay, within 15 years, the payday loan industry grew from nearly nothing to 22,000 storefronts across the country. Those stores opened specifically in the communities that the earlier government maps had designated as ineligible for bank lending. Okay, add it all up. A household earning $35,000 a year, unbanked, carrying a subprime auto loan, paying overdraft fees, check cashing charges, a rent-to-own appliance, a car insurance premium tied to their zip code, and buying groceries from a corner store pays between $4,000 and $7,000 a year in fees and premiums that a household doing the exact same things with better financial access does not pay. That is between 11 and 20% of their gross income taken through loan rates, bank fees, and insurance premiums, the same products available to everyone, priced differently by zip code and credit score. That is 2 months of wages handed over every year legally to publicly traded institutions. That's crazy, right? A household earning $35,000 a year, unbanked, carrying a subprime auto loan, paying overdraft fees, check cashing charges, a rent-to-own appliance, a car insurance premium tied to their zip code, and buying groceries from a corner store pays between $4,000 and $7,000 annually in fees and premiums that a middle-income household doing the exact same things does not pay. That is between 11 and 20% of their gross income extracted through legal financial products before they spend $1 on food or rent. The products that extract those fees were built for a market that federal decisions created. Federal maps drawn in 1934 cut entire neighborhoods off from credit. A GI Bill in 1944 built the American middle class for some veterans and locked the door for others. A deregulation act in 1980 removed the interest rate limits that had kept lending constrained. 22,000 payday storefronts appeared in the following 15 years, all of them in the neighborhoods those earlier government maps had designated as too risky to serve. All right, the people paying this surcharge know what it costs. They pay it because there is nothing else. And the reason there is nothing else goes back 90 years to decisions that are documented and specific. Directing the solution at spending habits is the most common mistake because it aims the correction at individual behavior while the cost is built into the loan, the fee, the map. Being poor is not just a shortage of income. For millions of Americans, it is a system of financial penalties that shows up at every transaction, from the car loan to the bank account to the insurance premium to the housing cost. And none of it required breaking a single law. If this video showed you something you had not seen before, subscribe, because this is what we do here. We show you how money actually works, where it comes from, and what the math looks like underneath decisions that everybody told you were perfect. personal. The history of money is everywhere, including in the zip code you live in.